Welcome back to Invest in You. Hit like, subscribe. This is going to be a 5-video series where I'm going to show you what I look at when I want to invest in a company. All those complicated financial stuff, the ratios, all the know-hows. We're going to dumb it down to our level and not sound all fancy dancy and actually just understand it, be correct about it, and use it to our advantage. So over a series of 5 videos, we're going to look at the non-financial info I look at, the free cash flow, the debt to equity ratio, the EPS, the all-important PE, but my preferred the PEG ratio, the gross margin, the quick ratio, the return on equity, and obviously we're going to look at the dividends. All these things I'm going to show you how I look at it, where to find it, what to read into it, because please remember, one ratio will never tell you how a company is going to do. You need to look at more than just one. So let's make it easy. Let me show you what I look at, and maybe you can use it to suss out some stocks for you. So we're going to look at the qualitative stuff, the non-financial info, and then we're going to look at the quantitative stuff, because those are the fundamentals that everyone always talks about. So I just thought I'd use this to seem like I know what I'm talking about. I do know what I'm talking about. It's just, it might sound too easy because it is. Don't let anyone try and tell you to overcomplicate it. Yes, there's a lot of complicated stuff to it, but we are going to make it easy to understand. The first and most important thing is you need to look at what the company does. You can't just go and invest in a company and you have no idea what they're doing. You're like, just take my money. You know, you need to understand what they're doing. You need to understand if it's a tech company, how the tech works. If it's an energy company, you need to know what forms of energy. If it's a consumer cyclical stock, you need to know what they sell, who buys it, and guys, we are in the brilliant advantage. You and me, we are everyday people. We go to shops, we move around, we are between people that buy these things. So I always say, like, these high and mighty investors that have a lot of money, the chances are they have probably never set foot, or not in the past 5 years since they've been very rich, set foot in a grocery store. They don't always know what people buy. They don't always know what's going on there. They might know the businessy stuff, but you and me, we are in between everyone. We buy these things, we use them. So we know what people want and what people like. They have to go and do crazy studies and get all this data to actually determine what people want. So yeah, make sure you know what the company actually does. If you don't understand how the tech works or how the industry works, go look it up. You can never learn enough. Like, there's always something you can learn. And don't invest until you've learned about it, obviously. Like, you know, go do your research, go learn up, go find out how the stock works, and then make your decision. But if you don't want to waste so much time, rather first go for the companies that you know work. But if you need to diversify your portfolio and you need something you don't know, go study. The second thing I look at is, does it diversify my portfolio? Now please, you can't look at only tech stocks, or you can't only look at car stocks, because imagine you owning 5 car companies and then tomorrow everyone decides they're going to start using bicycles. You will lose all your money. Like, there's no doubt about it. So follow the all-important saying, don't put all your eggs in one basket. So you need to diversify your stock. And don't worry, we'll do a video where I'll show you how you can diversify your portfolio. But for now, when you look at stocks and when you want to invest, make sure you don't invest too heavily into one industry. Because yes, it's good to have competitive companies in one industry, but then you need to have another industry balancing it out. Suppose you own 2 car companies and you've got 2 energy companies. Now the pandemic hit, obviously the car companies were not doing too great because no one was buying cars, no one was driving around except for Tesla, you know. But in any case, but then if you have 2 energy companies, they still need to produce energy and they still need it, well, not energy as in also do oil. I'm talking about like renewable energy or like electrical energy, utilities. Okay, so if you got two utility companies, they will balance it out. So the two car companies does bad, the two utility companies does well. So you will still in the end make a green number. A very good thing also to do at when you, it's touches on financial stuff, but a very good thing is you need to go look at the history of what a share price has done in a company. Go look at the max, go look at the 5 years, go look at the past year. So obviously now in 2020, the past year is a bit difficult because of the pandemic. So obviously there's a big drop and that kind of ruined the pattern or the rhythm of it. But I would say one advantage of this is go look at what this company's share price was doing just before the pandemic hit. Because if it was climbing and growing great, it means this company was doing something right. They were onto something. And then obviously the pandemic came and just knocked it down. But that doesn't mean that company can't do that again, what they did before. Maybe, maybe not. But if they've got everything in place, for instance, let's say they developed a new product and that's why they were climbing, that now it just means it's still going to carry on. So that's a very good thing to look at. Another thing is markets, and we'll talk about this a lot still. Markets do this. They go up and they go down. So go look at the stock. Go look when it's been up. Go look when it's been down. Go look when it's done a stock split. Go look if it's, maybe it's in a cyclical downtrend, meaning it's doing this, but it's doing it down there. So at some point it's just going to hit the floor, you know, unless they do something to bounce up. So go look at that. Because if you look at a 1 month window, you've got tunnel vision and this stock might be shooting up. But if you zoom out a bit, you'll see that this stock has been going down in a cyclical pattern. So that means it's been doing very bad over the years. So watch out for that. In transport science, when you drive, the faster you drive, the closer your vision goes. So just slow down a bit and just open your vision a bit so you can see more of the stock and what's been doing. The history can give a good indication of what the stock has been doing, but it can also give a good indication of what's to come. Look at a company's growth, not growth as in value. Look at, is this company planning on expanding to other markets? For instance, a company like Starbucks, they might be planning on expanding into South Africa, or they might be expanding, yes, they might not have been very successful in Australia, but it still means they're expanding. So you want to go look at those companies that are expanding. If you're finding a company that's market saturated, they're in every country already, the chances of them growing is slim unless they come up with a new product. Let's just quickly talk about what's been happening in the market. Now, this is my first ever market correction. If you don't know what a market correction is, don't worry. All it is stocks have been getting ahead of themselves, and that's why you hear the terms always on the news. This company is overvalued, tech is overvalued, the Nasdaq's overvalued. So all that happened now was everyone decided to start taking profits, and the big catalyst to it was large tech investors started taking profits, and that caused a frenzy of sell-offs. Like, this market correction is nothing compared to what has happened before. This has been relatively controlled. Yes, there's like stocks that are falling 10, 14, 20%, but if you go look at the history, there's a lot worse market corrections out there that has happened. So don't freak out. In my personal opinion, this is the best time for you to start looking at what to invest in, because all these stocks are very, very affordable. Well, more affordable than they were a week ago. So now is the ideal time for you to get in. And it's a market correction. It's not a market crash. Anything the market is doing is it's making it more properly valued. It's making it more closer to its actual valuation and not all these overvalued. But we'll be talking about that in these videos.